morning or good day. Hi, everybody. Today, I'm going to be talking about a very special type of insurance policy that basically, uh, based on, I would say, around 2018, 2019 statistics. And the stats in nowadays, I don't think it changed that much. It's like, they're just saying in the industry that not even, or maybe a little bit more than, 50%, a little bit less than 50%, maybe like around 55%. I don't think it's even over 60%. So it's like close to half, either a little bit less than half or a little bit more than half of the American population, they're actually missing out. So the insurance policy I'm going to talk about today, it's called life insurance. My name is MD Khalid Mustaq. I'm in New York State Department of Financial Services, licensed property casualty and life insurance producer. So based on my knowledge, based on my experience that I have gathered, I believe I got my life insurance license back in 2007. Then I started working for a couple of companies. I even had worked for a company, as a captive agent. Then with the help of God, I started, running my small little agency down here in Jackson Heights, Queens, New York, USA, meaning that I'm actually representing, more than one life insurance company. Today, I will try to focus only on life insurance policy because I know you guys have a lot of questions. Because it's completely understandable. Like, just like the lawyers, they have their own industry. Each industry in America, they have certain type of, clausing, certain type of clauses, statements, naming, definitions, explanations, stuff like that. And not everybody is actually capable of understanding everything. It's not possible. So that's why, we call them professionals, right? Like each profession, starting from, handyman to, all the way up to like, give me a name, pretty much everything in our country. That's why, they want you to have a license. They want you to have a certifications, continuing education, stuff like that. Why? To give you guys the best services, right? So today, based on what I'm going to talk about here, it's actually New York State, based, scenarios, New York State based, everything pretty much. I really have to say as a disclaimer that, I'm not a lawyer. I don't give out any legal advice and I'm not affiliated with a law firm. And also everything I'm trying to refer here is based on New York State. State to state may definitely vary because we do have different states have different rules. So please, for your state to make sure if that is correct or not, exactly what I'm going to say now, maybe it could be a little different, maybe it could be completely different because state to state varies. We all know that, right? So let's focus on New York State. Okay. So based on New York State, pretty much now, so every time I'm going to be talking to you guys, certain things is going to be like, nationwide, no matter what, just like the federal laws, right? Just to let you understand. Just like, let's say the term insurance, it works for every state, right? It works for 50 states in America. Like, we can't say Californians, they say, it's, insurance in one way, and New Yorkers, they say insurance in another way, right? So this is like a universal thing, right? So same way, certain things like like death penalty, we do have certain states, they do have the death penalty, right? And certain states do not have a death penalty, but the only thing they have is lifetime imprisonment, correct? So same thing right here, so based on New York State and everything, if we are talking about today about the life insurance, what is life insurance? Life insurance, it's something that, once again, I really have to refer to the insurance terminology again, because insurance is what? If I'm not wrong, it's a transfer of risk, right? So pretty much every insurance that you have in your home, every insurance that you have at your office, depending on what kind of insurance you're carrying, it's all about what? Transferring of your risk. And risk is defined as what? Risk is defined as chance of loss, right? Or uncertainty, meaning that things that we don't have any control. Like, for example, you're driving a car after 5 minutes. After 7 minutes from now, you don't know. You could get into an accident, God forbid, right? And same thing, the house that you bought last year, God forbid, might burn down next month. So things like those, we don't have any control over. Those are the risks, actually, basically, right? Then once again, we're not going to get into peril today because we're not talking about PNC product. We're just going to talk about the life product here, right? In terms of life insurance, The risk here is the chance of death, meaning that no matter what, death is a risk that is going to come for everybody. I mean, there is no such a animal kingdom or no such a human being in the world who were born and never died. Okay, so we all gonna die one day. Either it's today, if it's tomorrow, or maybe day after tomorrow. But trust me, it's coming. If it's coming for me, it's coming for you. It's coming for everybody. So being said that life insurance, it's a very sensitive industry. I personally think. Why? Because I started my career actually, being a life insurance agent, like I said, back in 2007, 2008, 2009. I started working for a different company, going door to door with my senior agents, learning everything from the scratch, and also then I started, writing my own apps. I mean, writing my own application, stuff like that. And I enjoy it. Why? Because, it's obvious. Like, nobody likes to talk about their debt, right? Nobody likes to talk about their, how they're going to die. What if they die tomorrow? And, what kind of assets they're actually leaving behind for their loved one. It could be their wife. It could be their children. A lot of things actually being involved, when you talk about the life insurance. And a lot of people don't even like the word life because, once you talk about the life, the other name of life is basically what? It's like you're talking about death, right? We understand that. But guess what? I mean, is there any way you could evade that? Is there any way you could just bypass your death? There's no way it's going to happen, right? So what is the smartest thing? The smartest thing is, I mean, it's like I said, it's everybody has their own profession, right? So the purpose of this video is basically to educate you guys. Trust me. Every video I'm trying to make here, basically, I mean, putting myself in your shoes as a customer, putting myself in your shoes as an insured, putting myself in your shoes as a viewer, what would you think if you were to buy something like that? That's how I'm trying to, make this video, and I'm trying to make it as simple as, you could understand. And also, you could definitely research on your own. So that way, when you make a future decision like that, at least it could be benefiting from this video. If you get a little bit of benefit, then that's the only way, I think, I'm doing something right for you. Please write down the comment, how you feel about the video and how you feel about that, how much you learned here today and how much, what you're thinking, your future plans, stuff like that. Okay. So what's going to happen, actually, the life insurance, like I said, I'm talking again. So the life insurance it's a transfer of your, risk of what? Debt, right? So if we're talking about that, so we all know now life insurance is basically, it's an insurance, right? Which actually insures you the risk of your death, right? Meaning that if you have a policy in your hand and regardless of, when it's going to happen, as long as, you die and as long as you have a valid policy based on the policy contracts, terms and conditions between you and the courier, what's going to happen, the courier, basically, the insurance company, should come up and pay the valid claim, right? That's how it works for every insurance company, right? So I know as a customer, when you go online and you do a little research, you do come up with, a lot of names like, whole life, term life, universal life, variables. Then I bet you get confused. You're like, I don't know what to do. I don't know which one I should go for. A lot of time you even call a company and they send you a very good agent. And we know our partners. Believe me, we as an agent, we try our best to make you understand. But still, do we really understand everything? Is it possible to understand everything that's sitting in one, appointment for 20 minutes and then make a decision from there? Well, some people they do, and they just go up and just make the decision to go ahead and write an app to the help of an agent and submit that. And for some people, no, I need more time doing a little research and all that. And it's not just about how you feel and how you're going to take care of that, systematic procedure. It also depends on the courier, right? At the end of the day, the insurance company, they make the final decisions, right? They are the underwriters, right? When you submit your application to the help of an agent, what happens is it goes to the underwriters, right? And then the underwriters, they are the one, they, pretty much look at the application, they investigate every little, detail of the information that you put in. I bet they have access to pretty much a whole lot of things based on the government laws and everything. As an insurance company, as an insurer, they do have access to certain things to make a judgment on their application of a client and make a decision from there, right? And once we are talking about life insurance, just to let you know, I'm not a health insurance professional. I'm not insured by the health insurance licensed by the New York State Department of Financial Services. But I'm just going to touch down, at least one of the most important part of the life insurance that a lot of you actually don't even never even heard of that. Like once you submit your application, it's a very important part of the underwriting process, which is basically called MIB. MIB is a Medical Information Bureau. If you heard of it, that's okay. If you didn't, that is something like, every time you go see your doctor, every time the doctor prescribes you something, the next thing is what? People don't really carry prescriptions, on paper that much a lot. It's all electronic, right? Electronic, like, the doctors, they just, say in the they ask you which pharmacy you like, and they just send the prescription, virtually over there. By the time you've been, by the door of the pharmacy, what happens, like half an hour, 20 minutes, a lot of times the pharmacy actually already send you a text saying that, your medication is ready to pick up. That's how advanced technology we have these days. But it doesn't matter. It's a paper-based prescription, or it's a online virtual prescription, issued by the doctors. It doesn't matter. A prescription record, the prescription that you got today, it's going to stay in the system of the pharmacy, right? And also, the each and every prescription that you had. So let's say from the day one until today, if I'm not wrong, it goes through the system to MIB, Medical Information Bureau, right? This is one of the entity. Medical Information Bureau, actually, they have the database of each and everybody of you that you had a prescription. I would say, like, I don't know for how long past, but at least I know they have a history of prescriptions that you had, right? And based on that, what happens, the life insurance company actually, they have access to MIB records, right? So they will look at you, MIB records to see what kind of prescriptions you had issued recently, past, or whatever the timeline, whatever time frame they have, based on their own company underlying, procedures, and also based on how long MIB actually will let you go back, or how long they will actually let you have an access. It's completely an internal matter. Even very recent prescription, like that was issued to you 7 days ago, if it's already showing up in the system of MIB or not, it's all internally controlled by between MIB and the insurance company that you applied for. So as an underwriter, they look at every little detail of everything, right? So looking at the prescriptions, I'm sure they, pretty much, they look at your, medications that you're taking, if you have any high blood pressure history, if you have any diabetic history, if you have any cancer in the family, stuff like that. Also, every health question that you already have answered on that application. And, that application could be paper-based. And if I'm not wrong, a lot of states, they actually have online-based, like, the agent could just do, the applications, the apps. We say, instead of saying the whole word as an acronym, we say apps. Over the phone, they could just, listen to you, put the data in, and then submit it as a virtual, right? In New York State, even until today, if I'm not wrong, pretty much, I'm not sure if they have that, if the state already allowing that virtual, or, submitting applications virtual in New York yet or not. If it is, that's great. If it's not, the only way we do it is paper-based. Or you could have both. Like, New York State, I'm not sure if they have the paper-based and also the virtual, options to submitting application or not. It doesn't matter. So what happens is, all the questions that you answered through on the apps, paper writing, with the help of an agent sits down, ask you all the questions, and he takes the note on the applications, right? He checks mark like yes or no and discriminations. Descriptions and everything. And I apologize, I misspelled. This is my, I try my best to speak in English, but at the same time, I kind of get caught up because I do speak 2 or 3 other different languages. I apologize. Or also, like, if the apps have to go through virtually, like using an iPad or using a tab or using a laptop, the agent had to answer the questions by asking you all the questions, right? So underwriters, they look at everything from top to bottom, right? And at the end of the day, they come up with a decision. That's the point of, making a final decision of whether they will, approve a policy. Now I'm going to talk about the basics of, very common types of life insurance policy that you have, in our states or all over America, if I'm not wrong. There are basic 3 different types of life insurance policy that, you would hear mostly in most cases. Number one, you would hear about the whole life policy. I'm not going to touch down in detail of each type today. I'm going to try to make another video of at least on whole life policies and explain a little bit of, if I'm not wrong, at least I will try to come up with certain points based one of certain companies references and stuff like that. Everything I'm saying based on my experience, everything I'm saying based on the experience and references that I see down here, and based on everything they're saying right here. So it's not just I'm just saying because I feel so. No, it's not like that. Based on my experience, things that I know. If I'm making any mistake, please, I apologize in advance, because this industry as well, they change every second, right? Just like any other industry. So everything I'm trying to give you today based on the up-to-date knowledge that I have, and the based on up-to-date references that I see down here. So the whole life policy, once again, it's also known as, a lot of people call it as, it's a permanent policy. And there's a reason why people call that, right? Whole life policy, it's a policy that people actually, they could purchase as early as, depending on the company or depending on the career. Some company, they even issue whole life policy, if I'm not wrong, since the child was born, right? Could be like a zero age. Some company, they start at 11. Some company, they start at writing 14 years old, young kids. Some company, they start writing at 18 and up to like 85 years old. So whole life policy, just a basic policy, and a lot of people call it permanent. The reason people call it permanent is because as long as an insured means you, the customer, right? You pay your premium on time, you should be covered for the death benefit. All right. Once again, as long as you pay your premium on time after being approved by an insurance company, your death benefit, right? The benefit of your death, meaning that, once you have a life insurance policy, if you die, what happens? The proceeds, the death benefit that you are supposed to get based on the contract between you and the insurance company when you actually have taken that policy, when they approved you and they give you a binder in your hand, correct? Pretty much every insurance company, they send you a binder. In my experience, I used to have a very nice binder, give it to the customer and say, thank you for your business. And also I used to explain, the client, actually, this is a very important document you're saving, in a very important area at your house, because this is basically a legal document, legal contract between you and the insurance company. The agent might come and go in a company, but the binder stays. So this is the contract between you and the insurance company. And the binder looks very, very nice. I mean, very professional. And nowadays, actually, pretty much every company, they send you, via email, like, the same thing, maybe, I'm not sure, they're sending you both, or at least just a hand-to-hand, or maybe they're sending you both, like, they're giving you a binder and also they're sending you virtually. It depends. So whole life policy, it's a very ideal policy who is looking into like a death benefit, sort of sense, like, no matter what happens to my life, as long as if I pass away, my beneficiary should be entitled to get the death benefit. And the basics of whole life policy, I'm not going to go into detail today, because I'll try to make another video on at least making a couple of points on the whole life policy based on the references. But at least one of the very attractive part of whole life policy is called cash value. Cash value is like a CV for you to understand, or you can call it cash value. Whole life policy, a lot of our senior agents used to say it's like buying a house. Like, you actually bought a house, and what happens over the years, 5 years, 10 years, 20 years, the house builds something called cash value, right? I'm sorry, equity. So for you to understand, you could see it as you buying a house. Once you have a whole life policy, you could think about like you just bought a house, like $100,000 of a house, for example, right? So 10 years from now, the house might, give you, equity of, let's say, like $10,000. In the same sort of nature, thinking that way, if you have a life insurance policy of $100,000, and let's say you are 32 years old today, when you be like 42 years old, and if you have a permanent or whole life policy based on the terms and contract with the insurance company between you and the insurance company, you could see they could have a very good cash value. The cash value, it's not a guaranteed product. It might go up, it might go down. I don't think any company, they are even allowed to give you or maybe they are, but I don't really think, I don't really think company actually even tells you, like, like this is the percentage that would be for your cash value. Because if I'm not wrong, because cash value is something, it might go up, it might go down, because cash value, if you break it down, it's made of dividends and interest. So the interest might be company paying a certain percentage, and the dividends might go up and down based on the company's income, based on the stock market and everything. So for you to understand, if we make it very simple, as long as you have a cash value building up over the years, you're building a very good maybe cash value. That's why a lot of people try to use the whole life policy as a kid's college plan, meaning that let's say you have a $500,000 whole life policy. 20 years from now, you could have a very good amount of, like, let's say XYZ amount of cash value. And cash value is something you have the right to take it out as a loan. If you take it out as a loan, a lot of companies, they actually make you pay like 4% or 5%, whatever interest rate they have to pay it back. But the thing is, it's not like you have to pay it back. I mean, you could take it out as a cash loan, or you could take it out as a cash value. If you take it out as a cash value, if I'm not wrong, you'll be taxed. You'll be taxed either upfront, or you'll be taxed at the end of the year. If you take it out by taxing it upfront, this is what you call tax deferred. And if you are paying tax at the end of the year, this is what you could call tax deferred, meaning that you're just paying taxes. Meaning insurance company should send you a 1098 or 1099, that sort of IRS document, so that way you could bring it to your accountant to do your tax filing, because this is something you earn, right? It's an income. So saying that, talking about the whole life policy, just once again, it's like buying a house. Now you're going to jump into term life. Term life is something basically, you could think about like, you're renting a one-bedroom apartment, and you might be renting that one-bedroom apartment for like, let's say like 2 years, maybe 5 years. A lot of, renters, landlords, they don't really give you like, more than a year lease nowadays. But thinking about 1 year, 2 year, 3 years lease. But at the end of the day, the basic thing is you're just renting that one-bedroom apartment, right? So term life policy, it has terms. Terms means like, some company, they go up to 10 years, they go up to 20 years in most common. Some company even go up to like 30 years. The term insurance policy, they do have the insurance premium. Once you get approved by a policy, that tend to stay, remain fixed. Meaning that if you're, paying the first month of premium, let's say like $100 today for a $500,000 term of 20 years, even after 20 years, your last insurance premium payment would be $120 or whatever the amount I just say. So meaning that the premium of the first month, let's say if you're talking about 20 years of premium, and 20 years times 12, it's like 240 months, right? So the first month of premium, if it is to be $120, the 240th month of premium would be $120, because that's just the nature of term. Term insurance policy do not have any cash value. Just like you're renting an apartment. You never own that apartment, you're just renting it. So term insurance policy is basically something, it's good for a lot of people that they actually purchase their home, and they are recommended a lot of time to buy a term insurance policy on their home. Let's say, John, he just bought a mortgage. He just bought a home with a 30 years mortgage, and his mortgage is like a $500,000. So John could definitely try to get a 30 years term to protect himself if it is to something happen, let's say 2 days, or even after the policy has been issued, let's say like 10 years from right now. So if John has a 30 years policy, meaning that if John has a term policy of 30 years, meaning that John should be covered for 30 years. And let's say John also has a home with a mortgage of 30 years, right? So if something to happen to John after 10 years from now, let's say the mortgage amount was $500,000, and John took out like $600,000 of term policy for 30 years. So if something to happen to John after 10 years from now, what's going to happen? As long as John has a valid claim with all the terms and conditions, the insurance company should pay the $600,000 to John's beneficiary. Let's say John's beneficiary will be John's wife and 5 children, right? It depends, every family has their own options. So what's going to happen, since the children are very small or young, not even 18 years old, let's say John made his wife the only beneficiary, right, for the sake of argument. So John's wife, Mrs. Joan, would be getting a $600,000 check. And guess what's going to happen ideally? Maybe she's going to pay off whatever the mortgage she paid for 10 years minus whatever the total amount, then whatever the difference, she's going to pay it off in one shot. Or maybe at least she will have a $600,000 check in her hand to go and pay the monthly mortgage as she goes for next 20 years of the mortgage. And also she will have a big chunk of money to do something like running a business or investing for, for kids, for the future college education, stuff like that. This is how term policy actually ideally helps our clients. Then the next one I'm going to talk about, it's called universal policy. Universal policy is a very flexible policy. And I was told, and I had seen a lot of my senior agents, they actually recommending their clients age from 45, 50, 55 and up. Universal policy is sort of one type of, whole life policy, but the universal life policies, the premium might go up and down, the cash value might go up and down, even the, face benefit could, the death benefit or face amount could, face benefit go up and down based on what type of universal policy. Because, basically, there are at least like 3 different type of universal policy. It could be like, at least, just give me 1 second, at least, it could be indexed, it could be variable, it could be guaranteed. I don't do any variable. In order to write a variable policy, you're gonna have to be, licensed to Series 669 and 6. I'm not licensed with those, so I never do variable. But just for the sake of argument, they're saying, cash value growth. It says varies based on the type of universal life policy. For example, indexed or variable or guaranteed. So once again, universal, it in a nutshell, they're just saying basically the premiums are flexible within certain limits. That benefit, they're saying flexible within limits, things like that. It's a little different, nature than just a straightforward, whole life policy or permanent policy or term policy or temporary policy for you to understand. That's it for today. I will try to make another video specializing, the benefits of whole life policy, especially. And I'm going to be making more videos on, life insurance policies, age, why age is so important for life insurance policy. It's a very common sense. Like the earlier you purchase a life insurance policy, your premium will be lower. The more you are delaying to purchase a life insurance policy, not only your premium will be higher based on the life insurance calculator of the age, of your age, current age or attained age, but also your health condition might change. A lot of factors could change. Health is very important for a life insurance policy. Let's say you're 30 years old today, you're buying a $100,000 life insurance policy for, let's say for the sake of argument, only $75 per month. Then, a friend of you, he doesn't believe in life insurance whatsoever. At the age of 45, 15 years from now, he just deciding to purchase his own policy. Believe me, imagine you had a $100,000 policy paying $75. If I say that, then 15 years from now, his friend is trying to purchase a policy for himself for $100,000 based on his conditions, his health condition and everything. Same $100,000, that benefit for 45 years old of your friend might be paying up like $300 or $400. Same thing going back to you. If you are buying a policy today with $100,000 face that benefit for $75 per month, if you're the same person after 15 years thinking of purchasing a life insurance policy, your price as a quote might come down, or even finally it could be finalized by the underwriter that you'll be paying, let's say like $300 for $100,000. So the earlier you purchase the life insurance policy, it's not only savings for you because you pay very less, and the later you go to purchase a life insurance policy, not only you pay a lot more premium, but also based on the health conditions and other factors, it might even be denied. And if you're basically denied, what are you going to do? Because they do have the right to at least deny you based on your backgrounds, health conditions and everything. That's just the way the industry runs, right? So the message should be here that we all as an American, we should have at least one life insurance policy, especially all the dads around America. Me as a dad, father of 2 daughters, that's what I believe. And that's what I'm here to talk to you about today. So do your best. Let's protect ourselves by having as much insurance policies as you can. So for the rainy days, we'll have something to take care of us as for financially. All right? That's it for today. Have a good one. I'll talk to you guys in the next video. Bye bye.